Welcome back to our channel, Clear Value Tax. My name is Brian Kim. I'm a certified public accountant, and today we are going to be discussing what are the chances of getting audited by the IRS. So the probability of you getting audited, it's really dictated by three factors. So the first factor is your income level. The second factor, it's going to be the types of reporting that's being performed on your tax return. So the activities on your tax return. And the third one, it's in general, does your tax return have anything unusual, suspicious, or anything out of the norm? So we'll jump into that. We'll jump into the details about each one of those factors. But starting with the income level, let me just tell you the statistics straight from the IRS website. This is public data. This is straight from the IRS website. So in the most recent year, there were 150 million individual income tax returns filed. 150 million. And 900,000 of those, approximately, were audited. That's 0.6%. That's less than 1%. Okay, but you can't say, okay, so I got a 0.6% chance of getting audited. No, it depends on your income level. So just generally speaking, we'll break that down by income level, but the more money you make, the higher chance or the higher probability that you have of being audited. You could think of it like a business. The IRS is clearly not a business. So the IRS, if they go audit a person that makes a lot of money and they find an error, then they're going to probably end up paying the IRS a lot of money. So the IRS will, in a sense, win a lot of money. But if the IRS, they go after somebody, who makes little money or no money, and they find an error, then, whoop-de-doo. They're going to say, oh, you messed up, you screwed up, you owe us $100 more in tax. That's not a victory. It's just a waste of everyone's time and resources. So there's obviously just a natural inclination to go after the people who make more money because there's a higher reward, I guess, for the IRS for catching those errors. So with that being said, here are the statistics broken out by income levels. If you make under $500,000, you have a 0.5% chance of being audited. Okay, 0.5%, that's under 1%, that's half a percentage point. That's 1 out of 200. If you get audited out of the blue for no reason, you're just unlucky. That's 1 out of 200. If you make 500,000 to 1 million, you have a 1% chance of being audited. If you make 1 million to 5 million, you have a 2.2% chance of being audited. If you make 5 million to 10 million, you have a 4.2% chance of getting audited. If you make 10 million and up, you have a 6.7% chance of being audited. Okay, so you have to take into consideration that these are just the averages within those income levels. If you have certain types of activities, which is my point number 2 earlier in the intro, or if something seems unusual, you're going to substantially increase the audit risk. So, like I said, if you make under 500,000, just within that income set, within that income group, you have a 0.5% chance of getting audited. However, that's going to increase substantially if you have certain activities going on. I'll give you examples. What will increase your audit risk? So, if you have a Schedule C, just naturally, if you have a Schedule C, that's elevated audit risk, okay? Schedule C, that's the reporting of business income for independent contractors, sole proprietors, or unincorporated business owners. So if you have a Schedule C, you naturally have increased audit risk. Okay, I actually have a specific video about Schedule C audit risks, Schedule C audit triggers. So please go check that out if you have a Schedule C, if you're an independent contractor, sole proprietor, or business owner. So just know that, just if you have a Schedule C. Okay, what else will elevate your audit risk? If you have losses. If you have losses, that's going to elevate your audit risk. So what do I mean by losses? Just losses in general. A good segue, because we just talked about Schedule C, is that if you have losses on your Schedule C, if you're reporting losses on your Schedule C, you're going to increase your audit risk even more, okay? So What are other losses? We're talking capital losses, losses from investments, losses from rental properties. Those are losses. Those are losses that are deductions that are reducing taxable income in most cases. So that's going to increase audit risk. However, you can't. It's not just a yes no for is it going to increase audit risk, yes or no. It's going to be based on the size of the loss. So if you're reporting Schedule C losses of $1,000, okay, that's going to increase your audit risk minimally. However, if you have Schedule C losses of 50,000, that's a totally, different scenario. That's a different case. That's going to increase your audit risk substantially. So you need to also take into consideration and be mindful about the size of the loss. So that's going to matter too. Okay, so if you have certain expenses or certain deductions that are relatively high in comparison to your income, that's going to elevate your audit risk. I'll give you an example. So if you make $50,000 a year and you're trying to report $20,000 of charitable contributions, whether it be true or not, it's going to increase your audit risk, okay? You make $50,000 of income and you're reporting a $20,000 deduction for charitable contributions, it's going to increase your audit risk because that looks out of the norm. Okay, now let's look at another example. If you're trying to deduct $20,000 of charitable contributions, but you make $5 million, now that does not look out of the norm because, okay, obviously $20,000 compared to $50,000 of income and $20,000 of charitable contributions compared to $5 million of income. Okay? Just think about it. All your tax returns, there's no human looking at all the tax returns when they're being processed. They're being processed electronically. All the tax returns are processed electronically. And the electronic computerized system, they're just scanning. They're just scanning for this deduction relative to your income. They're looking for any kind of I guess variance well out of the norm, compared to the average filer or to the average filer in that income level. So if they're going to find any anomalies, anything out of the norm, of course it's going to be a red flag. That's going to increase your audit risk. So keep that in mind. Okay, another thing that's going to increase the audit risk is if you're simply just not reporting all your income. If you're getting like a 1099 miss, that tax form for a sole proprietor or independent contract, if you're getting a 1099 miss and you're not reporting it, the IRS, they have a copy of that too. Whoever your payer is, whoever your issuer is, they gave you a copy. They give a copy to the IRS too. If you don't report that, that's a big no-no. You're going to get flagged for sure. And then that's also going to increase your audit risk for a full-blown audit. So, you don't want to miss your income. You don't want to not report your income. So just keep that in mind as well. These are just simple errors. That's going to elevate your audit risk, which can simply be avoided. So just keep that in mind. Okay. So those are items that will increase your audit risk. Just one point, one thing that is, good news is that over the past 10 years, due to a lack of resources, due to a lack of funding, the IRS audit rate has actually been declining. So, that's actually working in favor of the taxpayer, where your audit risk is just naturally decreasing due to lack of resources. Okay, so I hope you found this video helpful. If you have any questions, please feel free to leave a comment or question below. If you found this helpful, please give us a thumbs up or a share. We'd highly appreciate that. Please subscribe, and we look forward to making many more videos. Thank you so much.